Once liquidation starts, the line forms fast. Assets are sold, creditors are paid in legal order, and by the time unsecured suppliers, contractors, and shareholders are reached, there may be nothing left. What gets sold is broader than many people think. It can include property, equipment, vehicles, stock, and even intellectual property like patents, trademarks, or customer lists. But the hardest value to keep is the business as a living business. Once trading stops, goodwill, brand value, and specialist assets can lose value very quickly and sell for far less than expected. And before most creditors see a pound, the pot is already smaller. Liquidation costs, legal fees, and insolvency practitioner fees are paid out first. When liquidation begins, normal trading usually stops. Contracts start ending, and the impact lands quickly on customers, suppliers, and employees alike. That matters because liquidation is rarely something you reverse later. Once the business is in that process, the window to save it can shrink in days, not months. If the company is still fundamentally viable, acting earlier can keep other routes open, including a CVA or administration, before liquidation becomes the only outcome. Liquidation doesn't stay private. It becomes part of the public record at Companies House, which means the event can be found long after the company itself is gone. That visibility matters because lenders, investors, suppliers, and potential partners often run due diligence checks before they say yes, and liquidation is one of the first signals they see. Even when a director acted properly and followed the rules, trust usually isn't rebuilt overnight. Future backers may still want more proof, more time, and a clearer story before they commit again. Long before formal liquidation begins, many directors are already living with months of cash flow pressure, calls from creditors, and the daily uncertainty of not knowing how much time the business has left. That pressure can become deeply personal when guarantees are involved, because a company problem can suddenly threaten a director's own finances as well. And even once liquidation starts, the strain doesn't always lift quickly. The process itself can run on for some time, which means the uncertainty can keep hanging over everything for longer than people expect. If a director has already taken one company into liquidation, that history can surface when another business they run goes through a credit check. That can show up in practical ways. A lender may trim a facility, a supplier may ask for faster payment, or credit may be refused altogether. It doesn't happen automatically every time, but the failed company doesn't always keep the fallout contained. In some cases, it follows the director into the next decision. The earlier you act, the more room you usually have to look at real alternatives, like restructuring the business, negotiating with creditors, or using a CVA or administration before liquidation is fixed. And if the business can't be rescued, moving quickly still matters because it can stop the position from deteriorating further while debts, losses, and pressure continue to build. At that point, a licensed insolvency practitioner can talk you through the routes available and the likely consequences of each, so the next decision is based on clarity rather than panic. Liquidation doesn't just reduce what comes back. Assets can sell at a loss, creditors can still fall short, and fees are taken out along the way, so the final return is often smaller than people hoped. It can also bring the business to a halt. Trading stops. The reputation damage can linger, and for directors, the pressure is often personal, constant, and exhausting. That's why the strongest move is usually to get advice early, while there is still room to compare routes and make a deliberate decision before the options narrow. In the end, liquidation isn't just the end of a company. It's one decision that can keep shaping finances, operations, personal pressure, and future trust long after trading stops. Speak to an expert to ensure you make the right decision and understand your options.